VICI Properties is down over 5% today after the US inflation rate came in a little bit higher than expected. We can see analysts giving it a buy rating with quant giving it a strong buy. It is one that I added again today to my portfolio. We're going to take a look and see why this company is super undervalued and if you should consider it for your portfolio today. We're going to also take a look at the financials of this company, their top line revenue growth, as well as analyzing their bottom line. We're also going to take a look at the health of this company, total cash versus their total debt. And we also want to see how this real estate investment trust performance compares to others in the industry over the last few years. One thing that is important with VICI Properties to discuss is their borderline safe dividend score. We're going to take a look at the supporting metrics to understand if there is any need to be worried with this company. And the other things that we like to do within our own analysis is to take a look at insider ownership, understand if there are any insider buys or sells, as well as take a look at the institutional ownership. It's always interesting to see if they are buying or selling as well. And a few key things we do want to remind you from the latest investor presentation about this company, why we see it as a very strong contender for one of the best REITs to hold in your portfolio. And the main part of this is running it through that valuation model, getting to the intrinsic value, finding our acceptable buy price given our investor margin of safety, and talk a bit about Wall Street and their expectations for the future of this REIT. So let's jump into the historical performance. As we mentioned, they are down over 5% today after the interest did come in slightly higher than anticipated. We can now see that over the last 12 months, they are down 14%. But over the last 5 years, they are up around 27%. Bear in mind, this doesn't include those dividends reinvested. And they currently trade towards their 52-week low with a yield now of 5.6% and a P to FFO forward looking very cheap at 11.5. So let's take a look at the numbers of VICI Properties. And what we can see is when we want to see REITs especially, we want to see 5 to 10% growth year on year. Now we are starting from December 2017 when they were listed, and we can see 201 million reported on their income statement. When we take a look at their latest annual accounts, 3.6 billion. So they are growing at a very rapid rate. And when we look at it graph form from 2017, it is growing in the right direction that we would expect from a REIT. What's also important from REITs is that we do focus on their adjusted funds from operation per share growth as well, which we will cover later on in the episode. Bottom line has also been increasing, 43 million in 2017, 2.5 billion. And again, when we do look at that growth, similar to their top line, their bottom line is also increasing over the last 6 years. Always a very important sign to understand when we do look at REITs that their numbers do continue to increase. And again, very nice to note that with VICI Properties. A quick look at the health of the company then, total cash versus total debt. December 2017, 184 million of cash on their balance sheet. The latest quarterly report, we do note 523 million. So their cash position, whilst it has been very inconsistent, it does sit at an amount that was higher than December 2017. But 523 million, it doesn't really mean anything unless we do take a quick look and compare it to their total debt. Now, numerically and directionally, as it would be typical for REITs, we do see their total debt increase from around 4.8 billion in 2017 to around 17.6 billion. So again, it is typical that we do see this with REITs. We do know their total debt is increasing as they do essentially issue equity so that they can grow faster and faster. But again, important to understand the relation of this to that dividend safety and the adjusted funds from operation growth, which will be covered as part of our financial metric analysis. Now, REITs in this industry, in the other specialized REITs, we have Iron Mountain Incorporated, Gaming and Leisure Properties, as well as a few others very strong that we have also reviewed individually on the channel. So over the last 12 months, VICI, including dividends reinvested, one of the worst performing, down 10%, pretty much in line with GLPI. So again, not the greatest performance. When we do expand this to over the last 5 years, VICI Properties is up around 65%, and we can see the third best performing, so roughly in the middle. Not the greatest return over the last 5 years, but as always, past performance is not an indicator of future performance, and we are going to take a look, especially at the valuation, at why this does look to be incredibly undervalued and one of the best REITs for long-term growth. Now we're going to take a look at their growth rate. They did get given an A+ grade. Historical speaking, so over the last 3 years, their adjusted funds from operation has increased by 9.45% year on year, well above the sector median of 3.97%. Over the last 5 years, 8.5%. Again, they are beating the industry on average, as we can see, 2.3%. In terms of their adjusted funds growth looking forwards, 6.42%, when the others in the industry are facing struggles at 1.7%. And year-on-year increases at double digits, again outperforming the industry on average, hence why they do have a very strong A+ rating. Now, when we compare this to their profitability, they also get an A+ rating, although there are some things that we will cover. They get an adjusted funds from operation payout, forward-looking 75%. Sector median is pretty much in line with that. Personally, I don't agree with the C+ rating. I think that is pretty strong at 75 when the majority of REITs as a whole are around the 90%. We also note when taking a look at their cash from operations, significantly higher than the sector median, 2.18 billion. We have the sector on average at 238. So a lot of really positive metrics here to note. EBIT margin, which we can cover, a lot higher, 92% versus the sector median of 21. Overall though, if you want a high level grade on their profitability, it does get given a score of A. Now, before we do jump into their dividend safety and the financial metrics, a quick look at insider ownership. Now, 0.25%, not the greatest. We see no insider selling over the last 12 months, but we see an insider buying and in fact 86,500 worth. We can take a quick look at this. What we do know, in fact, on the 14th of March, one of the directors bought 3,000 shares at an average price of $28.85. Not the largest amount, but we would say this is a very bullish signal when insiders are buying. It does indicate they believe the share price will go up. And an interesting thing is, if you do buy at the current price, you would be buying right now at a cheaper price than the insider himself. When we take a look at institutional ownership, well, 98%, very high. 2.7 billion worth of sales by the institutions over the last 12 months. Nearly double the buys by the same institutions over the same time period. So we can see overall in 2023, quarter on quarter, institutions were buying more. Q1, now we don't have the full data set for the whole quarter, but so far we do see a little bit more selling than buying. But as always, with institutional buy, with insider buys, do your own due diligence. It is interesting to note what they do. It can be part of your investment thesis. Like we did see the insider buying, it is a bullish signal, but also understand you need to understand the business and do your own reviews. Now, what we want to point out is in their latest investor presentation, there are a few things that if you are first time hearing about this company that we do want to draw to your attention. Very positive, but again, let's just be clear with this company. In terms of the number of tenants they have, they've got 13 spread across quite some really big names. You have Caesars Entertainment, MGM Resorts, the Venetian, a lot of them that are based out in Las Vegas. Now, number of properties and WALT, what this essentially refers to is the weighted average length of the term of the lease. Now we can see with the majority of these on average is sitting at 41.6 years, with their largest client being Caesars. As we can see, it makes up 40% of their annualized cash rent, having 31.6 years left, so they don't need to renew it anytime soon. And if you do think about it, Las Vegas, do you really believe in 31 years time, 32 years time, that these clients, these tenants are not going to renew the lease? We're talking about an industry that is thriving, an industry that is growing, and we can look at some of those statistics. But very simply, next time you do go to Las Vegas, or if you do take a look just online, you can see it is one that continues to be filled with tourists as well as local residents. Now, in terms of looking at the top two, 75% of their annualized cash rent does come from Caesars and MGMs. This could be something you could be worried about, two large clients, but again, given that the weighted average lease term is very high, personally, I don't see this as any issue at all. They are also 100% triple net leases, so any issues with maintenance, upkeep, does all fall down to the tenants themselves. Now, Something that is quite interesting to note is the fact that their rent collection in 2020, so if you are looking at a period of struggle for the economy, for clients, for tenants, that would be the period you could argue when there was lockdown, a lot of places were shut, people couldn't go out. They managed to recoup 100%, so they had 100% of their rent collected. When you compare this to others in the industry, 70 to 99%. Again, remaining lease terms. Now, you may not believe this, but 8 to 11 years is in fact higher than what it is for when we take a look at some of them in terms of Realty Income's tenants. So we've got essentially a company here where it's around 42 years on average. Very strong, no real worries when you are considering whether or not these tenants will be leaving. And high barriers to entry, that goes without saying, whereas a lot of them in the industry are low. So lots to like here. We also can point out very quickly their same store rent growth is around 1.7% over the average of 0.4%. Finally, the way they do return a lot of excess cash to investors is continually increasing those dividends quarter on quarter, and we can see over the period it has increased 7.6%, which is nice to note. We will come on this when we look at the metrics. When you want to compare it to others in a similar industry within the REIT space, EPRT would increase around 6.3% over the same period, ADC around 6%, FCPT at 3.7%, and one of the most loved dividend stocks, or in fact monthly dividend payers, Realty Income at 3%. So you are getting a lot of growth on their dividend as well, something that it is important to understand. And as we mentioned, 100% cash dividend raised every year, and they target the 75% AFFO payout ratio, which we'll come on to, but that is very, very positive as well. Now, before we jump into the metrics, just to let you know, we have released our latest free weekly article. If you want to gain access to this, and we do run through 10 undervalued dividend stocks, not just undervalued in dividend yield theory, but also on a forward PE basis, click on the pinned comment below. You gain instant access to all of our articles here, no cost whatsoever. Now, in terms of the dividend safety, quite an important metric that you want to understand. 50 score, borderline safe, market cap 31 billion. It is a large cap company. So let's go and understand a lot of these metrics. Now, because they listed in 2017, we have no recessionary data to share with you today. What we can share with you, their latest increase to the dividend, 6.4% in September 2023, much higher than the 4% minimum we advocate on the channel just to keep up in line with inflation. Over the last 10 years, or in fact over the last 5 years, 10% growth year on year on average, so we're looking at double-digit growth to their dividend, and they are a company, or in fact a REIT, that has just started to pay dividend, given they just listed in 2017, and we see that 5 years of consecutive increases. Now, in terms of dividend yield theory, it states a company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation here, 5.88 versus 5.03. Also on the forward P to AFFO, 12.6 versus 14.8. So with this double undervaluation signal, do bear in mind we don't look at any of these signals in isolation, and we will conclude near the end. Now, they are also lower than the sector P to AFFO at 13.7. So let's take a look at the metrics. Now, adjusted funds from operation payout is something we focus on for REITs, while for other stocks we prefer to look at the free cash flow, although it is a lot more volatile for REITs. Below 75% if we want to be specific for hotel REITs, otherwise it is 90%. Pretty much bang on year, they hit their target that we mentioned of 75%. No worries whatsoever. 2024 expected 74%, so I would be surprised if we don't see a very high single-digit increase at a minimum to their dividend this year. Adjusted funds from operation has also increased over the last few years, expected to increase again in 2024. And when we take a look at the percentage-wise as well, very strong, pretty healthy, in fact nearly double digits every single year. FY24, a bit of a slowdown though, down to 4%, which is still acceptable. In terms of their top line growth, well, as we mentioned, for REITs, 5 to 10%. From 2017, very, very strong growth. We note a flat period in 2019, but even since then, we're looking at 36% in the more recent year. And numerically, as we already covered, they have been increasing their top line at a very rapid rate. One thing that is important to understand with REITs, yes, we love it when companies do share buybacks, returning a lot of excess cash to investor pockets. With REITs, they will do the opposite. They need to issue equity so they can fund their property acquisitions. The reason for this, after paying those dividends, they don't have a lot of internally generated cash flow. VICI Properties, unfortunately, similar to Realty Income, are one of those REITs that will dilute your position at a much quicker rate than others. So do factor that in, not just to your margin of safety, but also into your investment thesis for adding this into your portfolio. ROIC then for REITs 3 to 5%, just to give us faith that management are able to effectively allocate their capital. Pretty strong in my opinion, above the maximum 5% in that borderline that we look for. 8% in 2023, looking very healthy and attractive to potential investors as well as current investors. Operating margin very strong as well, even though it is inconsistent, still looking very healthy at 92% in 2023. And the most important factor for that dividend safety, the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. These numbers show us the number of years it would take the company to pay off all of their debt net of cash on hand. Probably the one area of this company that I do believe would like to see a lot better. For hotel REITs, we want to see below 3.5. Bear in mind, this does essentially correlate to both dividend safety and balance sheet strength. They've only been below 3.5 in the more recent period in 2021. It has gotten above that significantly in the more recent year at 5.86. Now they are looking to reduce this. We can see that in 2024, but it is still above what we really want to see, which is why they have that borderline safe score. What I would say is they have been increasing the dividend at a very healthy rate. Their adjusted funds from operation payout is around the 75%. So right now, there are no real red flags for this company. As I mentioned, this is one I have been buying, in fact, adding today. But again, always consider the information before you invest and do your own due diligence. Now, in terms of the valuation, as always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. We can go into the first valuation model, the multiples valuation model, companies in a similar sector and size. We have the P to AFFO with the average, and we get the intrinsic value in today's episode for VICI at $32.15 with our first undervaluation signal. We then move on to the second, which is the dividend discount model. The increase is year on year, and we can see on the period at 8% or just under. We've gone a lot more conservative, so bear in mind in our valuation process, we're trying to be as conservative as we can. And we get a second undervaluation signal. Again, understand we don't look at any of these valuation models in isolation and conclude towards the end. We then have the DCF model with the average growth rate at 39%. We've gone a lot more conservative at 6%. In conjunction with the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we can see here the intrinsic value shows, again, another signal of undervaluation. So with these models, we essentially get the average to get our intrinsic value for today's episode of VICI Properties. And remember, it has been hammered just today due to that inflation coming in a little bit hot. And by a little bit, we are talking 0.1%. However, the market has reacted in this way, which does give a lot of opportunity to those who are looking to buy. Bear in mind, you can grab a copy of this valuation model if you want to get to the intrinsic value, as well as the acceptable buy price of companies in your own portfolio by clicking on that pinned comment below, as well as if you want to get to the intrinsic value of companies in your own watch list. Starting off then, margin of safety at 10%, we use that if we believe a company meets 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. And then we keep going till it's near the current trading price. And what we can see for today's episode isn't at a 25% margin of safety yet, but it is at a 20%. So for VICI Properties, our MOS level, based on our estimates and judgments, sits between 20 to 25% at the current price today. In terms of Wall Street, what is their expectation? Well, they see some very nice upside, not too far off our intrinsic value over the next 12 months with 27%. And as we mentioned at the beginning of the episode, all 3 analysts do consider this to be a buy now for the portfolio. As I mentioned, for full transparency, this is one that I already held in my portfolio before the episode. I also added today. But as forever, do let me know your thoughts in the comments below. Is VICI Properties one you're looking to add? Maybe you still have it on your watch list because you believe it will drop further. Do let us know below. As always, if you did enjoy the episode, smash that like button. Don't forget to hit the subscribe and bell button so you are continually notified of these videos as they drop. And as always, we'll see you all on the next one.